IPOs usually I'll say, hey, you have to avoid. CoreWeave, after they reported earnings, the stock fell below, what was it, $50, I believe. And we said this is a $100 stock, right? And, we said it on Wall Street Unplugged Premium and also Wall Street Unplugged because I feel like people didn't understand the total addressable market and what was going on. The CEO did a great job addressing. Listen, we've got some stuff wrong. That's okay. We're talking about IPOs. Another one was Circle. And this is why I'm bringing up Circle, because Circle has been absolutely on fire. I mean, this is a company, let me see exactly where it's trading right now. You're looking at 118. And what a shitty job by the underwriters. JP Morgan, Goldman Sachs, and Citi, I believe, were the lead underwriters on this stock. And holy cow, they get this wrong. They left billions on the table, right? I mean, just in fees and billions on the table. This is supposed to come out 31. And what did it open up like over 100, right? When it comes to Circle.
Oh, I don't think it opened up that. No, it was in the 60s.
In the 60s, but then I think that day
it surged, yeah.
Yeah, I mean, it went up to the 90s, and then it touched 100, and it pulled back down. But this is like right off the start, and you had Kathy Wood saying with her ETF, she's buying at the open and stuff like that. And we covered this in depth on Wall Street Unplugged Premium just before it came out, and actually said, look, this is another name that's going to go up considerably from here. I didn't think it would open up where it opened up. I didn't think it'd be there a couple of days, but you have to look at the IPO, and the way you need to analyze these companies is looking at their total addressable market. And people are looking at price to sales, which, okay, if you want to look at price to sales, it's a shitty metric. If you looked at price to sales, you probably would never have any major wins in your portfolio because you wouldn't own any of the major technology companies. You wouldn't own the Apples and Microsofts and Netflix and stuff like that. So price to sales doesn't work. So for me, instead of going price to sales or a PE ratio, right? Well, all these, look what PE for Netflix. I mean, well over 100 for how long? Look what that stock does. One of the largest in the world, in the top 7, I think 6 or 7 companies in terms of market cap now. You have to look at the total addressable market and if this company is the best company within that total addressable market. And here's what I mean. You're looking at stablecoins. Stablecoins are a massive deal. Okay, it provides a centralized, trust-based approach to managing public sector data, right? Which is much better than the current system, which is centralized. Meaning that stablecoins are going to streamline operations, provide better data protection, reduce fraud, much lower cost, better for everyone, right? That's how you disrupt markets. And they're going to offer much higher yields compared to the shitty yields that your bank is offering. So if you're wondering how big the total addressable market for this is, stablecoins, right now, the alternative... Okay, and you're looking at this. This is the alternative stablecoin to traditional finance. It's cheaper, faster, better for customers, provides higher interest rates, more safety, right? They processed over $33 trillion in volume last year. You could be like, holy shit, $33 trillion. You know what that is in terms of the global M2 USD money supply as a percentage, Daniel? $33 trillion?
There's got to be a goofy amount.
1%.
I was going to say, there's got to be a goofy amount.
It's only 1%. So you have a technology, again, cheaper, faster, better for customers, higher interest rate, more safety, much better all around. So why the banks are jumping in. If you're looking at JP Morgan hiring huge digital asset teams, Citigroup just had a big get together with their digital asset team, a special conference call. I think it was a 45-page report. They talked about stablecoins and how big this is. You're looking at Circle as the pure play from an equity perspective. So you have 2 stablecoins accounting for 95% of this $2 to $5 trillion market. The $2 trillion lowest estimate, and this is me not saying, oh, look how big this market could be. The $2 trillion from the Treasury is predicting this is going to be a $2 trillion market. A lot of people have this at $3 to $5 trillion. Most people. This is the Treasury. So the lowest is $2 trillion. Okay, Tether accounts for 67% of that total addressable market. Again, not publicly traded stock, and it's not going to offer you equity if you buy that through Coinbase or wherever. And then you have Circle, which has a 27% market share. So together, they're 95%. And if you think Circle is expensive here, I want to give you an example. Because when you look at Apple in 2007, when it first released its iPhone, it was like, holy cow, this is great. People didn't know. The PE was 35, which was really expensive back then. It's not like a 35 PE today where people are like, wow, it's growing. 35 PE was, I mean, you talk about when PE ratios were like 15, 16 back then. Right? So it's almost like double the market and it had a $170 billion market cap. Today it's $3 trillion. $3 trillion. That's what Apple's market cap is, right? Because their total addressable market is huge. Now, why in the hell would I compare Apple to Circle? Because you're like, it's too totally, is it? Because stablecoins has a bigger total addressable market than smartphones. And with stablecoins, as of right now, there's much less competition right now. Okay, banks trying to change that. So when you're looking at Circle and you're looking at it going, wow, it's $100 and this is crazy. And people are talking about even CoreWeave, the lockup period's coming. I don't care. Because I think the people in the lockup, I don't think they're going to sell it because CoreWeave's the same thing. They have access to NVIDIA, great chips from NVIDIA, right? They streamline their system. They only take on debt when they take on new clients. So I'm not telling you to go ahead and buy CoreWeave at 130, 140, 150 here when, again, told subscribers to one of our newsletters take a small position, under 100. And if you listen to podcasts, you bought it at 60, under 60 probably. But when it comes to circles, start out with a small position. Just buy a little bit. If it comes down and you think it's hyped up, buy more. You're talking about a company that's on an island by itself. You can say Tether, but Tether you can't really buy. And Circle is the pure play in this market that all the banks are dying to get into, are trying to rush into this market because they know they've been screwing their customers with fees and garbage and all the red tape for such a long time. Now you have the blockchain, now you have Circle, now you have stablecoins, which disrupts one of the biggest industries in the world that was untouchable for over 100 years. Finally, that's what Circle is. Okay, so people are telling you, Circle, you're crazy. This IPO, it's IPO mania. It's not IPO mania. There's 2 IPOs. That's it. That worked out like this. And both of them have total addressable markets that are incredibly massive, that people do not want to analyze stocks like that. I have no idea why I don't look at total addressable market. They look at shitty PE ratios and they look at price of sales and they miss the Palantirs. They miss the CoreWeaves. They miss the Netflixes. They miss the Microsoft early on in their trends because they're looking at the wrong metrics. The reason why I know is because I used to look at those metrics and I'm a fundamental analyst and I got that shit wrong. And now I'm not getting it wrong anymore. That's why we have a lot of great big winners. Yes, we have losers and we have names that we stopped out, especially during tariffs and stuff like that. But look at the massive winners that we've been talking about, whether it's the Palantirs, the CoreWeaves, the Circles. A lot of these names continue to go higher and higher because their total addressable market is massive, and some of them have moats around their business, even when it comes to Netflix. You might not think that when I get to Disney in a little while, but it's definitely true where they are the leader in streaming and they're killing it in an advertising platform. Is just getting started. It's just getting started when it comes to Netflix. So, lots of positives there. I just want to talk about Circle really quick. So,
No, I like Circle. We ought to talk about Netflix. That's a good segue into it, because I was going to ask you about that because I saw Bob Iger on CNBC, Frank. I know you know this, but Disney went ahead and went against your wishes and paid lots of money for Hulu. But I have one stat for you that I thought was fantastic from Bob Iger. Now, I'm not saying this is making me a fan of the Mouse House. I do think, though, in the world of sound bites, this was absolutely brilliant. It shows you the power of marketing and a team around him. He went on CNBC, Frank, and he said, the year before I returned back here, they lost $4 billion in streaming. And now this year, we are going to make a profit of $1 billion. That's a $5 billion turnaround. In scene, that's all that matters, Frank. That's how you do TV, my friend.
Yeah, he did do that. And congratulations that Iger did that. But I could tell you the way he did it is wrong. And you may think I'm crazy here, and this is why. Look, I have a company that's growing. Okay, we're growing. We're seeing more traffic on our platforms, getting more subscribers, and that's great, right? For Curzio Research. I could have our profits increase dramatically if I fire all of my employees. Right? And in the next 6 months, I'm going to say, wow, profits are up tremendously because salaries are our biggest expense. And now we're cutting that back dramatically. However, how the hell could I possibly grow my company with no employees? I'm giving you a drastic example, because what Iger did is he cut spending dramatically. He fired tons of employees. He fired tons of talent. And most importantly is he cut back tremendously in the billions in terms of how much content they're providing for Disney Plus. And that's why it is profitable. So, yes, you could brag about that, but what you're doing as a long-term strategy is you're weakening your company. But what pissed me off at Iger, and I think Iger, from what I know, from what I hear in circles, is not a bad guy. Horrible job, grooming Chapek, right, to be, your successor, which is horrible. Now he was stuck coming back to the company when he wanted to retire and live like a peaceful life. I didn't like the interview because I'm just so surprised at Disney. Their growth model, right? We're not talking about this and parks and no. Their growth model is 100% streaming. And if their growth model is 100% streaming, good luck with that. Because one is they just announced, and they were positive at Hulu, whatever, they paid $400+ million, and it could have been $5 billion or whatever. And he talked about that like it was such a positive. They hired a third party within Comcast to buy the last 1/3 stake in Hulu. And there was a floor valuation, which I said, whoever provided that floor valuation as a lawyer for Comcast, I mean, he should give him, millions in options. Great for you, because this is a secular declining business. So you're bragging that you didn't have to pay higher because Hulu's bleeding subscribers. Okay, YouTube TV is 1,000,000 times better. Plus they have football and sports, and that's who you are competing with when it comes to these companies, which is Google, which is Apple, which is Netflix, which is the biggest companies in the world. So you're going all in on this model, meaning you're competing against who? Amazon, Google, Apple, Netflix. Have you seen those balance sheets? These guys are increasing spending dramatically on content. They're buying sports rights everywhere. This is what Disney's trying to compete with. Okay. And they can't compete with them. They're lowering their content. They're cutting their cost for content, for new content, which is insane. While all these companies are massively ramping up because they have the money, because this is like, it's not even a secondary, it's a third, fourth business for them. Right. So they have unlimited capital to grow their streaming businesses and spending tons, right? Especially sports rights. While Disney continues to cut. Now, there's so many red flags here, Daniel, because ESPN Plus, they plan on charging, they came out $30 a month for. $30 a month you're going to charge for ESPN, considering you no longer could afford Major League Baseball rights. So you're not going to have Major League Baseball after this year. You also cancel your deal with Warner Brothers and Fox to launch a huge sports streaming service. Why did that happen? Okay, there was a big announcement. It was good. I think we called it Venue or something. It was going to be the biggest thing ever. Oh my God, it's great. And they canceled it. Why did they cancel that for? Think about it. Can't be good. You're looking at Marvel movies. Marvel movies used to be the greatest thing in the world. Automatic $1 billion. You could remake the same Spider-Man movie. You're going to generate $1 billion. It doesn't matter. Good for you. That's amazing that you're able to do that. Seriously, the same Spider-Man movie before they really started getting to No Way Home and stuff like that. Right? But they're no longer generating $1 billion in the box office. And this is their best content, which, as I've been explaining, comes out in the movies first, then on the Disney Plus platform. So how do you compete with the big guys who have more money than you, who release their new content on their streaming platforms first? So you can't compete on content. And how do you reward your subscribers? Saying, okay, we're a smaller company, so maybe we'll charge cheaper prices. No, they're charging higher prices. You're raising prices on them. And Iger actually said, you know what? We have room to raise prices further. Do you? Good luck with that. Because now what are you going to do is you're going to provide a worse experience for them by throwing commercials everywhere. It's going to be like, have you seen, I'm not going to pick on sites, just in case a lot of these guys want to have me quote me on different things. I don't want to pick on the media sites in finance that you can't even look at because there's 27 pop-ups that come up before you even get to the story. There's like 3 or 4 of them now. They're an absolute joke. You just can't even watch them. Yeah, they generate money from advertising and stuff like that, but it's just, you can't even read the story, right? Customers are starting to get pissed across the board. Right? Everyone raised prices considerably over the past few years to account for inflation across all businesses. But if you're providing a worse experience for them while raising prices, they will leave. I've been leaving almost everyone that has done that to me. Because you're raising prices, I get it for inflation, but now your service is shittier because you laid off employees. I'm not going to go to your restaurant. I'm not going to subscribe to services that are worse like that. And people are starting to move elsewhere. Okay, it's opened up tons of new business for entrepreneurs, which is great. That's my interview with the Savvy founder. Again, we just released that yesterday. Listen to that, how he's going after Airbnb, because Airbnb used to be the greatest service ever. Great, disruptive, cheaper, faster, better for everyone, better for you. You have hosts on there that have a bunch of properties. Now they raise prices considerably. So what is he doing? He's undercutting that and saying no fees. Okay, that's what you do when you open up these businesses. When you disrupt the market, it's great being there. But even with Uber, you charge higher fees. Now all of a sudden, people are starting to use taxis more, right? So with Disney, there's a lot going on under the hood, Dan. It's another wave of cost cutting that just took place. That does not sound like a growing business to me. It sounds like a business that's trying to survive. The cost cutting include reduced spending on content and letting go of 100 employees in the film business, right? And that layoff announcement was just a couple weeks ago. It's the 4th and largest round of layoffs in the past 10 months. Okay. And it's all across Disney's television operations and different operations. This does not sound like a company that's on the wave of growth. And all the analysts are bullish. You have 30 something out. It's 27 that are buys, 6 are holds, right? So most people are very, very bullish. And maybe it goes higher from here. But if you notice what my thesis was, Dan, what was my thesis on Disney been? It's not that
open up parks.
Open up parks, right? Open up thousands of parks, license the content, because you do have that content, which is great library. Not necessarily for streaming, that people are going to subscribe streaming to watch Dumbo, 20 times, right? Especially if they watched it like 30 times. But if you're going to buy Disney here and you think it's going to go high, it could go higher. That's fine. But my thesis has been with that opportunity cost. I said, own Netflix, much better pure play on streaming. Own Amazon, own Google. Amazon is where you get streaming. Along Google, you're going to get AI and cloud, which are massive growth catalysts. Since 2023, January 2023. And by the way, I'm not just picking a random date and cherry picking here, because if I go back further, it gets a lot worse for Disney. If you go back since January 2023, Disney is up 20%, Amazon's up 130%, and Netflix is up 280%. Okay, opportunity cost in investing is everything. So why own Disney, who's competing against the bigger guys, when you could own some of those bigger guys? One, you could own a better pure play Netflix, just starting out with advertising, massive. Right? Going to see massive revenue growth going forward. Stock's on fire right now. Or you own Amazon on Google, which, again, you're getting AI and cloud along with streaming as they're growing streaming and paying for sports rights and going crazy. And you have Disney, who's lowering their costs on content spending, which means that experience, if you're not providing better new content or spending more on new content, then what's the reason why to go to Disney Plus? Okay, so I think they're going to bleed subscribers. The stock, I wouldn't say is super expensive here. It's been flat for 5 years, same price in 5 years. I just think there's so many better opportunities if you really want access to streaming than Disney, and I still feel that way.
You can go back further than that. Frank, in the middle of 2015, Disney was around exactly where it is today. So if you bought it in the summer of 2015 and held, granted dividends, they cut them but reinstate them, but you would be flat on that.
That's
you would have
insane.
seen spikes to 200 and down to 80, but to your point, that's wild.
Yeah, it is wild.
Hey, somebody that is paying attention to you, Universal just opened up a new park.
Yeah.
Just south of
And
us.
it's on fire.
You going?
Epic. No, I won't go near it.
No.
Have you seen the lines? Go to YouTube and look at the lines of that park. Oh my
No,
God.
I haven't.
I mean, you could buy the super fast
I saw the
pass.
guy on the making the rounds on the
Yeah.
TVs. I mean, it looks cool. That's not my
And the
bag.
prices for Universal are freaking insane.
Like Austin
They're
Powers.
insane. They're insane. They're insane. I mean, the costs continue to rise, and I think Kramer actually asked Iger that and said, what about your costs? And he's like, well, we provide a better experience. Really? I've been going to Disney for 40 years. I live in Florida. I still go, and I stopped going to Disney probably 3 years ago because the experience is not better. It's more crowded. It's more expensive. Plus, you went way left and stuff like that. It's just, for families and stuff like that. This is the core market. A lot of them don't want to see craziness at DEI and stuff like that. They just want to go there, forget about everything, and have a great time with their kids. So stop throwing politics in their face. And Iger got that, right, and pulled back. Not all the way pulled back, but he definitely pulled back. Chapek was just off the hook. Holy cow. It's insane compared to what it is now. I mean, Epic is charging crazy prices. If you go there, I think it's 2 months out. You can't even get tickets for 2 months out now. It might have changed.
Good for them.
And people love new parks. So just Disney is great at parks. Open up 100 parks everywhere. Doesn't matter even if it's 5 years or 10 years from now. That's why Tesla has a massive premium. That's why AI companies have a massive premium. It's because of what's coming on in the future, right? That's how stocks trade right now. It's holy shit. Disney, 5 years from now, they're going to have another 10, 15, 20 parks open. You know how much money you generate from that? It's incredible. You know how many partnerships you could make? I mean, people will build the parks from you if you market them. I mean, it's insane. Seriously.
Hey, that's what they're doing overseas.
That's what they're doing overseas. They'll build a park for you if you can market them, and you can lower your costs and just have all these parks all over the place because people love it. They want to go away. And I tell you, in the current Disney parks and even the Universal parks, there hasn't been much change in them. A new roller coaster here or there, but once you go several times, you're like, especially being in Florida. You go once every 3 years, 4 years, like when I was living in New York, it's different. When you buy an annual pass and you go maybe 3 times a year, I don't want to go to Universal or Disney parks now. Now I've been going to Busch Gardens and stuff like that, which I think is actually Universal still. And that's been fantastic. Man, Busch Gardens, millions of roller coasters, best park ever. And my daughters love that place. But that's how I feel about Disney, and just open up more parks.
Park, yeah.
If you're going to buy the stock, buy the stock. You probably do okay with it. But I think the S&P perform it, and I think the alternatives that I gave you, Amazon, Google, and Netflix, are going to outperform them significantly and going to continue that way going forward because they just can't compete streaming. They're competing against companies that are literally 10x the size of Disney, 10x to 20x the size of Disney. They just can't really compete as much in that industry.